Where the stock market goes, so does the health and wealth of the economy. This idea has been reinforced time and time again, to the point that even people with little to no knowledge about the stock market are concerned with it. But what is the stock market? It's a free-for-all trading venue where companies can sell shares in their companies. They can kickstart their businesses with an initial public offering, raise adequate funds, boost their business with innovative products and a bigger workforce, and altogether increase their company value. Then, when leading investors see that their company's doing well, they'll want a share of the profits too. This share of profits is called a dividend. Companies give back a portion of their profits and revenue to investors that are proportional to the IPO or their share. We'll work with an example here. Say you invested $1,000 in Apple some 5 years ago. Apple's company value in 2018 was $746.07 billion. Today, it's $2.92 trillion. That means that your $1,000 would be returned to you as $4,507 in 2023. That $1,000 in 2018 helped Apple come up with better products and consequently raise its market value. Plus, they increased their workforce. From an investor's perspective, you struck gold. You saw potential, made a move, and now you're reaping the benefits of it. Not only are you boosting your own investor's portfolio, but you also have a chance to sell your shares at a profit. This doesn't have to be at $4,507. You can sell it for a number that you set based on market trends, offerings, and such. Now, from the average Joe's perspective, Apple's hiring, and you'll have a chance to work for a successful company that offers a good salary. The company's making more and more money, investors are interested, and the average guy's benefiting with a better return on their 401k, a better salary, and incentives. Do you get how the stock market dictates which way the economy will go now? This is, however, an oversimplification of all the facts and figures that are constantly on an investor's mind. The truth is that the stock market is highly volatile. We'll take Apple as an example again. In 2018, the company had actually decreased its market value by 13.46%. This meant that an investor from 2017 or before would be given less returns on their investments. Apple managed to recover pretty well, actually, but what if it hadn't? What if it wasn't just Apple either? What if more Fortune 500 companies were going through a hard time? What then? Let's go over it. The market's not looking great for several companies, and investors are worried. They don't want to lose money, so what do? They sell their shares as quickly as they can. In this case, they don't sell their shares for much of a profit, just whatever would help them recoup as much of their initial investment as possible. And we're not talking about just one investor here either. A bunch of them, let's say 100, are running around looking to sell off their shares. While they're frantically running about, the company's value is decreasing more and more. This is obviously not a one-day process. The company will try its hardest to bring back its market value and attract more investors. However, because they were devalued, they have to make some decisions, and not everyone's going to like them. They start laying people off, devaluing retirement funds, and eliminating incentives. It's chaotic, and that's called a stock market crash. When the money's not flowing in as it's expected to, the entire economy suffers. This has happened before. The first time was on Black Tuesday in October 1929. This was concurrent with the Great Depression, and some companies had no buyers even for a nominal price. What happens when you have no money in your accounts? You close down shop for good. The stock market lost $14 billion in value, and thousands of people were left unemployed. World War II ironically helped them stay employed in some capacity, and the stock market managed to recover until 1989. That was also in October and named Black Tuesday too. The Federal Reserve stepped up and the stock market managed to stay afloat and trade again another day until 2008. That's when the housing market collapsed, leaving several people unable to pay their mortgages, realtors and landlords in debt, and money leaving accounts. Again, the market managed to recover because it always does. But what if the market crashes again in 2023? September has long been considered a high-risk month in the investing circle. And as we roll into September of 2023, investors are starting to look worried. The truth is that while the stock market looks stable right now, many experts would argue that it's not sustainable. With rising oil prices, inflation rates, and wobbly economic ties with China, experts believe that a stock market crash is coming. One such expert would be Michael Berry. Barry rose to fame as the man who predicted the 2008 housing crash and subsequently rose to mainstream attention as Christian Bale's character inspiration in The Big Short. Anyway, Barry claims that a complex housing market, stock market discontent, high inflation, and rising oil prices are all contributing toward an inevitable crash in 2023. Again, it doesn't take a day for the stock market to crash. What happened, historically at least, was that when the stock market started to look stable, companies got ahead of themselves. For example, in many events, a company's market value is proportional to their CEO's salary. You'd think that this would motivate the guy on the top floor to make sure that everything's running smoothly, but no. In many cases, companies cut costs, reduce their workforce unnecessarily, and bring down consumer trust in their product. They also start to artificially raise their market value by buying back their own stocks and shares at a higher price to make it look like their company's doing way better than it actually is. Consequently, they sell the remainder of their shares at an unfairly high price. The common man can't even think of investing with them. But this is considered artificial growth. Let's say that from 2020 to 2023, several companies have been growing their values artificially. In 2023, with high inflation rates and increasing oil prices, they'll need to fess up. They'll start losing money because of the entire charade. The remaining investors would scramble and withdraw their shares, and the company would start losing money by the minute. The company suffers, and so does the workforce. You'll start seeing departments shutting down one by one, with the company announcing that they were obsolete. In reality, they just didn't have the money to keep them around anymore. You and the few people who've managed to keep their jobs would now be working more hours for the same or even less pay. Inflation is still happening, and the cost of living is increasing, but the employer doesn't have the money to pay you what it takes to live your everyday life. If anything, they don't have the money to supply their own raw materials or third-party warehouses now either. This company's done for, and so are about 100 others. The fourth economic crash in the US's history was in 2020 during the COVID-19 pandemic. Just like in 2008, the government had to step up and bail out companies, offer unemployment benefits, and attempt to shrink the inflation rates. But can the economy survive a third time? With rising tensions between the US far left and far right, it seems like an unlikely scenario in 2023. The far right would argue that remaining taxpayer money should not be spent on a bailout, while the far left would argue that more money or a better bill should be proposed. Without a bailout, creditors from all over the world would notice the US economic downpour and start asking for their debts back. This would only add more strain on the government looking for a solution. But how can they look for one with people being more agitated and frustrated over their lack of jobs and resources now more than ever? In 1989, when people were out of work during the stock market crash, they started to look at other ways to make money. You get where this is going. People are withdrawing their entire life savings from banks, but the banks need the money to operate too. They start putting withdrawal limits, and people are essentially robbed of their life savings. Still, the banks are insured by the government, but only if the government is semi-functional. What's the best they can do to keep the currency rate from devaluing any further? They closed down the stock market, which would have happened anyway if the third threshold at 20% had been reached. All in all, a stock market crash in 2023 is highly likely, with many experts recommending it's time to sell and sell fast. However, the long-lasting impacts of a stock market collapse can lead to complete turmoil. Society and the government will suffer. Let us know in the comments down below if you think a stock market crash is coming up anytime soon. Make sure to give this video a thumbs up and follow us for more.